Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. We usually do some looking forward here on the briefing, and we'll do some more of that today with our Chief Economist, Gerald Cohen. But we also do a little bit of looking back once in a while, and we're going to do that today too. Every January, Dr. Cohen and his team put out a little report called Five Trends, Five Economic Trends, talking about what to look out for in the economy in the coming year. So he's going to take a look back at that article today, talk a little bit about the outlook and where we are in comparison to what that outlook said in January of this year. Should be an interesting addition to the lineup today. So anyway, let's go through how we do this real quickly. For those of you who aren't with us all the time, Dr. Cohen will be on in a moment. He will present for 15 to 20 minutes, and then it will be time to take your questions. So you can submit those at any time during the briefing by going down to the Q&A function at the bottom of your screen on Zoom. You might find it behind the More button with the three buttons on it. Take a look there, and you should be able to see it. As I said, you can submit those at any time during the briefing. You don't have to wait till we get to the Q&A section 20 minutes in. So for those of you here with us from the media, if you could please let us know of your organization when you submit your question so that we can make sure to get to yours while we are still here on the air. We are going to do this for about 30 minutes today. If you're with us by phone, please go ahead and email me your question. You can find me at rob_knapp@kenan-flagler.unc.edu. Like I said, estimated 30-minute running time, so we're about ready to head off on that. I will welcome Gerald Cohen, who is the Chief Economist here at the Kenan Institute. Hasn't been with us for a few months, so it's good to see him back. Gerald, good to see you. Welcome.
Great to be here, Rob. Can you see me? Hopefully it says my video should be on.
I can see you and hear you. It's all good.
Awesome. Great. Yeah, so it's great to be here. I mean, I've been around the Institute, just not on the briefing. Happy to always share the wealth on the briefing. And although maybe I actually wished I was on vacation this morning, given that the data threw a bit of a curveball. So let me share my presentation and we'll go from there. So 1 second. Perfect. Okay, all right. Come on, computer. And let me start from the beginning. I was adjusting on the fly. So as Rob said, one more. Why is my computer? All right. As Rob said, what my plan is, or was and is to talk a bit about our five trends from that we discussed at the beginning of the year and update you on those five trends. Just to give you a background, kind of the five trends we talked about were the misery coming from potential inflation, tariff-fueled inflation, and weakness in the economy, potential weakness in the economy as a result of that. Then talking about the uncertainty created by AI, specifically regarding kind of long-term productivity, job loss, and then the impact of that on the Fed, and a couple of things that we were wondering if the Fed had incorporated, in particular, how to respond to higher productivity or job loss. And then the impact of that on the impact of the economy overall on our local economic activity as a part of our American Growth Project. And then finally, our grand challenge about the changing workforce and the kind of relationship between employers and the social contract between employers and employees. So I have thinking about though using that as the context, I've kind of thought about, well, what is new now since then regarding a lot of those issues. And so here's my summary. So the first is the latest employment data are worrying, or is worrying, maybe I should say. I think data, Rob told me it's a plural, it's a singular, and now as I read it, it is, or it sounds to be. So the latest employment data is worrying. I'll talk about that in a second. Inflation is creating more misery than we expected, but it's coming from two different sources. It's coming from the war in the Middle East and the impact of oil prices, and also the impact of AI on inflation. And so concerns about an overheating economy from that, although the latest employment data kind of calls that into question. Overall, the economy has held up surprisingly well, but the latest data, again, is worrying. Another new factor is Fed Chair's more singular focus on inflation. And given the continued high rates of inflation and AI's short-term inflationary impacts. And then I will talk at the end, so this is kind of a plan, about our upgraded despite this, we have all these uncertainties, and maybe we've done this right at the wrong time as the data is weakening. We have upgraded our forecast for 140 out of our 150 EMAs. And I should note that a decent amount of that comes from the strength that we saw in the first half of the year. We've been expecting modest growth in the second half, and this data says modest might be is right or maybe more optimistic. So turning to the data, again, my computer seems to be slow this morning. So as we saw a job loss of 23,000, weaker than expected, manufacturing up slightly, earnings up slightly, also weaker than expected. And the unemployment rate, despite all this, edged down. And that is, in some respects, as indicated by the participation rate falling. The headline on that is that the labor force is basically declining faster than job losses occurring or weak job gains are occurring. So let me show you that graphically. So we saw a job loss of 23,000. Expectations were at 82,000 gain. We had net revisions in the previous 2 months of 103,000. So there was much weaker than originally anticipated job gain, or much weaker job gains than the data originally indicated. There's nothing nefarious about this. I know I've talked about this, and my colleagues have talked about this in previous briefings. The fact is that at the response rate for this job survey is about 70% for the first month, and then it's over 90% as you get to the second and third month. So 3 months out, we have a pretty good read on what job gains are for the month ended 3 months ago. So that's the reason why we see these revisions. If you say, how do we minimize those revisions? Give the government more money so that they can increase the survey number of surveys or respondents that they ask, incorporate as much big data as they can. So the revisions are always going to happen, but we can lower them through more money for the government statistical agencies. I should note overall between that 103 revisions and the much weaker than expected job loss, we basically the job market is down about 200,000 jobs relative to expectations. So it's a pretty big miss, and we've seen markets responding to that. Fed funds futures there's now pricing in less of a probability of rate hikes in the next several months. So we're seeing kind of a market reaction to that. People are saying, wait, the economy might be weaker than we anticipated. And I did the same. Some of those, or in the last few months, the job losses have been the result of the government sector. So private payrolls look better, job gains of 30,000, roughly 30,000 in the last 2 months. But as you can see in this chart, it's not great. But it's better than the job loss that we saw in the last month and the kind of weaker gains that we've seen. So government sector job losses occurring in the government sector are causing some of the pain, but it's still the economy is fairly weak, or job gains are fairly modest. Now, given our demographics and given the weakness in the or limited labor force growth, and in fact the labor force in the last year is unchanged, um, you really can't get a lot of job gains because there aren't that many people to fill those jobs. So the fact of the matter is, given our demographics, given the growth in the labor force, I mean, 30 is a bit low, but in the 75,000 range per month would be kind of the equilibrium for job gains that one would expect. So this is one of the issues that we have to think about. In the past, the equilibrium was over 100,000, but when you're at 50, 75-ish thousand per month, it may not be surprising that you'll see some months of weakness and some months of strength. So we have to put that into perspective when we think about when we think about the labor market. Um, uh, and that's kind of also why the unemployment rate is edging down. It's not like we're creating a lot of jobs. It's that the labor force is declining faster than actually the unemployment rate is rising. Or in fact, the unemployment this data says that the number of unemployed has actually declined recently. Since January, we're talking about a decline of 450,000 in unemployed, but the labor force has declined by 1.4 million. So the labor force is declining, at least since the beginning of the year, faster than the number of unemployed are declining. And by the way, the job numbers, if you do the math, that suggests that the job number that by this survey, we've lost close to 1 million jobs in this survey. So two different surveys, one where we ask households, that's how we get the unemployment rate, one where we ask companies, that's where we get the payroll numbers. I'm gonna skip over the labor force data just to say, well, I mean, because I've effectively told the story. But another source of weakness in the economy is the fact that inflation is eating into households' purchasing power, and the wages were up just 0.1% and have increased 3.2% over the last year, while inflation is up 3.5%. So wages are not keeping up with inflation, which means purchasing power is being eaten into. The consumer spending seems okay. And the reason why it's okay, and I'm happy to talk about this, please open it up to Q&A on this. The reason why it's okay is because we've had healthy wealth, strong wealth gains, because even though gasoline prices are impacting people, the impact of gasoline is much smaller than it has been in the past. So people are doing okay and eating into savings, but it is a worrying trend. And one of the things that we saw in the payroll numbers that ties this in is leisure and hospitality has been seeing significant declines in the last few months, because people are not going out or not going out to restaurants, or not going on vacation or taking shorter vacations. And that's what you would expect. That's what we expected given the impact of of higher gasoline prices as a tax on consumers. Just to put some numbers on that, for every penny that gasoline prices go up, it costs consumers over a year about $1.25 billion. So gasoline prices are up over a dollar. Um, and so that's over 130, 125, closer to $150 billion that households are spending on an annualized basis on gasoline. So, whoa, let's see. So I was going to say, so misery. We talked about this at the beginning of the year. The misery index, which combines the unemployment rate and inflation, has been relatively low, but it has risen because of the inflation that we've seen as a result of the war in the Middle East and as a result of AI-driven inflation, both of which were not expected. But the economy has been resilient. But the question is this data suggestive that we're going to see weakness ahead? So there are two new factors that we did not anticipate, the war and AI-driven inflation. And to put some numbers on that, or to put some numbers on the AI-driven inflation, consumer prices for electronic goods, computers, telephones, things like that, are up 9% in the year ending June. That is the highest rate on record since data goes back to the 1970s, 1960s. And from 1980 to 2021, prices were falling. Every year, prices of electronic goods on a quality adjusted basis were falling, and now we've seen price gains. And I think a decent amount of that is because of a competition for those chips and things like that from AI. So even though a lot of it is coming through investment, we are seeing that impact on household prices. And as you can see in this chart, inflation remains well above the Fed's target of 2%, and the Fed has not hit its target in over 5 years. So there may be a reason why Chair Warsh is so focused on inflation. The question is, as you'll see in a second, is he too focused on inflation and not worried about the economy? And the data that we've seen may suggest he should worry more about the economy than inflation. So given this and the continued inflation that we've seen, this blue line is household long-term inflation expectations. And the question is, they have remained elevated in a way we have not seen in over 30 years. And the question is, are people now saying we have permanently higher inflation? And if the Fed were forgetting about, in my opinion, the Fed can respond to or not respond to current levels of inflation, or say we're going to look past current levels of inflation because of its oil or its AI. Well, AI may not be short term, but if inflation expectations become unanchored, the Fed really needs to respond. That worries me the most. And the fact that this blue line, which you can see, we saw spikes in inflation in 08, we saw an oil price spike. Long-term inflation expectations ticked up, but they kind of held fairly steady. But we've had this for the last few years, we've seen higher long-term inflation expectations. And so the question is do people think that that is permanent? And one of the questions about AI is whether demand is being pulled forward before we're seeing the productivity gains. And yesterday we got a productivity release, and I've been becoming more cautiously optimistic about the productivity gains coming from AI. But this data puts that into question because in the last several quarters, we've seen fairly weak productivity growth, despite all the investment in AI and all the hype in AI. I mean, it may look better than it's been in the terrible teens, but Um, this data suggests that we can be optimistic about the productivity gains of AI, but we're not seeing it yet. And I would encourage you to read my mid-year update, or maybe it's a little past mid-year update, because I talk about whether people are if that if that those anticipated gains are pulling forward demand, and how that is causing inflation, and whether the Fed needs to respond to that, even though, as Chair Warsh keeps focused on, AI may be a show long-term productivity gains. And so, turning to the Fed, I've shown this chart before. This is the Fed funds rate in black, and a Taylor rule, which is the model of Fed activity, um, or a model of how the Fed would react to the nexus of inflation and slack. And what this model said, and then what I've done in contrast to the past, is show you three different models. The orange line is what I would call the Warsh model, which is only cares about inflation. And the light blue line is my traditional model, which weighs both inflation and slack in the economy. And but all models say the Fed should be raising rates. Um, the current model, the worst model, says the Fed should be raising rates less because even though inflation is elevated, it doesn't care about the fact that we have run out of slack or that the economy is potentially overheating. While a model which incorporates slack, and I'm using the Congressional Budget Office estimate of slack, says that the Fed needs to tighten more. So a big question for you is, how much slack do you think is is the economy overheating? The latest data says maybe not. How much should you weigh current inflation? How much should you weigh future inflation? And as Chair Warsh is focused on, how much will AI lower inflation in the long term and bring rate relief? That's what he's talking about. But a lot of other FOMC members, and in my report I talk about this, talk about the inflation that's coming from AI at present. And then let me just leave you with well, two things. One is you can see how much AI is driving economic growth. Whoa. How much AI is driving economic growth? Sorry. Uh, there you go. The orange line is the orange bars are IT investment investment in IT software and hardware. The blue is everything else in the economy. So you can see how much growth is dependent on AI. And the question is what you think about continued, future AI investment. And then lastly, just to say, because I'm out of time, I'm sorry I went long, that despite all this, we have upgraded our growth for 140 out of our 150 EMAs. And we currently believe that none of our EMAs are expected to contract in 2026. So let me stop there, open it up to questions, and apologies for going long again.
Necessary, Gerald. It was kind of a wild morning here at Briefing Central, so the the tech wasn't always cooperating, and we had plenty of news to work with, so all good. Let's get straight to the questions. One from Matt Boyle at Bloomberg, which kind of links up with another headline. Do we see any evidence in this report from the recent ruling allowing the Trump administration to remove immigrants with temporary protected status, perhaps food service or healthcare service roles?
So I think it's hard to know specifically how that ruling is impacting, but I can tell you a few things. One is that um, um, foreign-born workers, or well, uh, um, play an important role in those sectors, or immigrants play an important role in those sectors. I just to well, um, in the food service industry, over 30% of the workforce is of Mexican descent. That doesn't mean they are recent immigrants, but they are of Mexican descent. Um, the Just because the government collects that demographic data, and over 40% in the uh, uh, gardening sector, and I think over 30% in the construction sector. So it's hard to know whether, so as I said, labor force is basically flat in the last year. And so it's hard to create jobs when you don't have people to fill them. And a decent part of that change is coming from the fact that demographics are saying our labor force is slowing, and our immigrant labor force is flat or shrinking. And so, it's hard to know exactly, but it's definitely played a role in the fact that our labor force has stopped growing.
You. Here's another one. This one's from Clayton Hinkle at NC Newsline, and this is also associated with a headline subject close to our hearts, and that's the start of the new college academic year. As thousands of college students return to campuses in the next week or two, based on the recent job trends, are there certain majors or fields you might gravitate toward or career fields you might avoid? Perhaps you can also touch on those fields most likely to be impacted by AI in the next 3 to 4 years.
So this is a fierce debate in the economics community about whether AI is going to create massive job loss, or AI is going to create, new fields, and there might be some pain in the transition. But historically, the latter has been true. Over the course of history, I've never heard somebody say, "I'm working too little," or there's so we've not entered the Jetsons life of working 3 to 4 hours a day or 3 days a week, and perhaps this time is different, but the general inclination, I think the vast majority of economists say that AI is ultimately going to create more jobs than we lose. And as I said, given our demographics and labor force, we may need that. The key issue is the pain, and how much pain AI creates in the short term. There's been people who've been working on this question of whether job creation, are there certain areas that you shouldn't enter, you shouldn't be a coder, you shouldn't be, I don't know. And my answer is, I don't know, but I do know, and we've been talking about this internally, our use of AI is that if you're a critical thinker, you can use AI as a leverage, as an assistant. And in general, if you think of AI as your assistant rather than the authority, and when we've used AI as an authority, we always regret that use, or I always find lots of mistakes, so I never use it as an authority. So I would say critical thinking, and learn how to use AI and learn how to leverage it. And whatever field that is that's going to inspire you. And I'm sorry, I don't have a better answer than that.
That's a fine answer, and it feels like a debate that's still being figured out, even as we see stories of some companies laying off people in anticipation of productivity gains from AI, and then turning around and hiring at least some of those people back. So it feels like it's a question that's going to take a while to answer.
Yes, exactly, exactly, exactly.
Uh, let's see. Here's one from Dan Barkin at Business North Carolina. Dan asks, what have been some of the permanent impacts on the labor force, remote work and such from COVID? So not just the ones that we saw for a couple of years, but the ones that are still with us.
So, interestingly, there was there was a decline in the labor force participation rate of like 50 older workers who were laid off or meant temporarily or to, whether it was temporary or, expected to be temporary, permanent. And we kind of saw this decline in the labor force. And again, it's hard to adjust because you just have people retiring. And so, you have people aging out of the labor force, but in that kind of 55 plus, especially the 55 to 64, you saw this decline in the labor force, during and in the aftermath of COVID. And then we ran into labor shortages, and that participation rate kind of ticked back up. And so it's not clear that we've seen that COVID has changed our labor force dynamics that much. But, and this is a great lead into our grand challenge, it's definitely changed the way we work. Much more hybrid work, much more flexible work. And there's been some recent studies saying that one of the challenges that new hires are facing, and maybe one of the reasons why the unemployment rate for folks with bachelors has been rising faster than the unemployment rate with folks without a bachelor's degree, is not because of AI, but because of the impact of remote work and the fact that it's harder to gain those skills from remote work, that it's harder to get that to learn from other workers when you're working remotely. My daughter, who works remotely, says her Slack channel is their water cooler, but there is some data suggesting that it's about learning and those questions. So again, I think that there are both. I'm a supporter of this flexibility, but I think and this is come to our our Frontiers conference on October 8th, because we're going to talk about this, how you balance that flexibility and get good coordination, get learning, is something that companies are grappling with now and are going to have to grapple with in the future as work continues to change.
All right, very good. That was a black diamond run briefing, I think, in terms of degree of difficulty. So thank you very much to Dr. Gerald Cohen for considering a lot of things on the fly and relating them to us this morning. There was a lot to learn from this one. Thank you all to everybody in the audience as well. We appreciate the great questions as always, and love having you here for this once a month on Friday mornings. So for those of you in the audience from the media, if you'd like to continue the conversation with Dr. Cohen or with any of our experts, please let me know. You can email me at rob_knapp@kenan-flagler.unc.edu. We'd be happy to help with any of the stories you might be working on. For everybody in the audience, and Gerald gave me a few things to follow up on here, but we hope you'll stop by our website, kenaninstitute.unc.edu. Among the things you can see or will see there, Gerald spoke about the updated GDPs for the major cities and regional areas around the country, part of our American Growth Project. There will be news up on that quite soon. And a couple of things that are already there. Our Grand Challenge, which has been running all year. There's a piece with Nicholas Bloom from Stanford talking about remote work that I think you'll find interesting. And all this leads up to our Frontiers of Business conference. As Gerald said, it's here in Chapel Hill, October 8th. We hope you'll join us. We'll be discussing a lot of the questions that we discuss here on the briefing, so it should be an interesting time. With that, I think it's time to close it down for today. Appreciate you being with us. We'll be back again on Friday, September 4th, so we hope to see you for that one too. Again, thanks very much and enjoy your Friday.
Thanks to the team, Kyle Henson working hard in the background, updating things on the fly, and the team overall, Cody Morris, Sarah Dickerson, for all the great work and updates, and again, read that mid-year report.
All right. Thank you, Gerald, and thank you all. Have a good Friday.